Welcome to Market Peeker. Today, we're diving into a crucial topic: risk management in Forex trading. Many traders focus on profits, but without solid risk management, even the best trades can turn into major losses. Let's break down the key principles every Forex trader should know. First, never risk more than you can afford to lose. A common rule is to risk no more than 1 to 2% of your trading account per trade. This way, even if you hit a losing streak, your account is still intact. Use stop-loss orders. Setting a stop-loss protects you if the market moves against you. It's easy to think you'll manually close a bad trade, but emotions can get in the way. Stop-losses take emotion out of the equation. Set profit targets. Just like stop-losses, profit targets help lock in your gains. Before entering a trade, decide where you'll take profits to avoid getting greedy and losing your earnings. Diversify your trades. Don't put all your money into a single currency pair. Spread your risk across multiple pairs to reduce the impact of one trade going wrong. Leverage wisely. Leverage can amplify gains and losses. Start with lower leverage to keep risks manageable, especially if you're new to Forex. Risk management isn't just a strategy. It's the foundation of long-term success in trading.